So previously, in many of the other videos that have been taught, we talked about market structure, right? We talked about how when the market is trading higher, let me just draw this in a line. Market is trading higher, it's making higher highs and higher lows, right? And as the market is trading lower, it's making lower highs and lower lows, right? And we talked about the detail that's inside of each high and each low that is there. The detail in each high and each low that lets us know that this is a valid pullback, and then this is the continuation. This is the valid pullback, and then this is the continuation. This is the valid pullback. We have a break. This is the valid pullback going up. Then we have a continuation down. This is the valid pullback going up. Then we have a continuation going down, right? So each high and each low, for the people who skip through this video, skip through the first video, skip through the whole crash course, you skip through the entire thing after paying to be here, you just floated all of it and you just plugged in a transcript to artificial intelligence and told you, tell me the most important parts of this video. I don't have time to learn it. This is for you. This is your saving grace, right? This is your last attempt to actually learn this the way that you need to. So what we generally have, and let me make this chart a little darker. So this should be a little bit easier for some people who are having problems seeing both the green candle and the red candle, right? So we see that this is an up candle, right? This is a down candle. We have an up candle there. We have a down candle here, right? The importance behind the up and the down candles is that when we begin to shift in market structure, right? When we begin to trade higher in market structure, what you see is a down candle get put in. And then as we begin to trade higher, you see a series of bullish candles get created to make their way up. Usually there's a down candle that's inside of here. Change the coloring. And then we have a bullish candle that trades up above that down candle, and we begin to trade higher, right? So it looks something like this. Looks something like that. We have that down candle, which we have over here, that represents this candle here. And then we have our up candle as price begins to trade higher. We are now creating up candles on the way up, right? So the candle in question that we are discussing right now, this is as it relates to bullish price action. When we begin to turn and we begin to make our way higher, we start to change the trend. We start to, whether it's a retracement, whether it's a reversal, whether it's a continuation, what we know is that it begins to turn, it leaves behind that down candle, and then we see bullish candles form and it starts to make its way up, right? So what we are paying attention to is none of these bullish candles here. What we're paying attention to is the last down candle, right? You need to listen to that. The last down candle. So we have the down candle there, and the next candle ends up turning bullish and trading higher. We don't care about any of these bullish candles that are trading up, right? What we care about is the last down candle that is present. The last down candle, that is what we call our R box, right? And I'm going to go into detail with that in a few, but it's the same thing with the up candle. right? We have an up candle that's there. And then after we create that up candle, we end up creating a series of bearish candles on the way down. So we have our last up candle here, and then you end up seeing us create down candles. You end up seeing us going down. Right there's another down candle, and then we create another down candle there, and then we create another down candle there. And yeah, there can be little bullish candles inside of here as it's heading down, right? But what we're paying attention to after price turns is we are paying attention to the up candle that's there, right? That is our anchor. So when bearish, write this down, when bearish, our anchor or our R box is the last up candle that is there, right? What does that mean? That means that if there's a bunch of up candles, price is heading up. The very last up candle that was printed before bearish candles started to show up and make its way down, right? The very last up candle that is there, that is considered our R box. And it is the same thing for bearish candles as well, right? The last bearish candle that is there, that is considered our R box, even if we're putting in a series of bullish candles going up. This bearish candle, the last down candle that is there, that is our R box. So this is when price pivots, when price turns and begins to make its way higher. We are paying attention to that. Some people like to call it the demand zone. Some people like to call it the what is it, the obstetrician block, the OB plus, whatever it is you want to call it, doesn't matter, right? It's the R box, right? That's what we consider it, the R box. That's the only context that we are giving that single down candle. So as we begin to make our way higher and we put in a series of up candles, and then after that we put in a series of, we might put in 2 down candles, whatever it is, and then we follow again and put in more up candles like that, right? What we're paying attention to is the lowest down candle that is here, right? The lowest down candle. So is this down candle right here, just highlight it, is that down candle in the white, is that the lowest down candle? No, it is not the lowest down candle, because there's a down candle that's lower than it, right? And if there's nothing else below this to the left, then this is what's considered our lowest down candle, right? So likewise, when we are up above, we are looking at the highest up candle. We have a series of up candles that are present. We are looking at the highest up candle before the market began to turn and print bearish candles for us, right? This is very important. R box, R, right? Like RR, risk reward, right? R, it is R box. That's for R, we call it retracement. That's why it's named R. Anything that you're introduced to during this boot camp, when you say it, you know exactly what it is that you're looking for just by the way that you say it. Even the model that we're going to teach in the future, in the next coming days, you'll say it, right? Say the abbreviations for it, and or the acronym, sorry, for it. You'll say that, and when you're saying it, you know exactly what you're looking for. I don't create foolish names like Venom and you know the Zaxby's, the succubus model. You say it. That's exactly what you're looking for, right? It's you're gonna hear what you're looking for in the name of the model. So with this here, this is the R box, the bullish, the bearish R box. The bearish R box would be the last up candle. And the bullish R box would be the last down candle that's there, right? So this is, I'm spending time on this because I know there are people, I already know this, who speed through material and think they don't need this. It's just an up candle, it's down candle. What's next? You know, just relax, right? Relax. The R box is the last down candle that is there, right? The R box is the last up candle that is there before we begin to turn. So let's put it into perspective for when we're looking at market structure. And I call this a structuralist system because that's exactly what it is. But you have to understand this in market structure. So with market structure, what we end up seeing is we put in this down candle that is here, right? Hold on, let me turn off the Zoom annotations because I have no idea why someone would even be annotating on the chart. Makes no sense at all. They should be removed from the chat, but you know. So we have this down candle that is here. And then when we create a bullish candle going up, when we create a bullish candle going up like this is where in market structure terms, right, we end up seeing that up move get created. The bullish candle is that up move trading higher. So this is generally where the last down candle's high was. We traded lower, and then we began to move up and trade above that previous high. This is known as the market structure break, but this would just be market structure on a lower time frame. So when we're drawing out something like this, where we end up talking about these lows that are trading down, and then we move high and break the previous high that is there, all we're doing is breaking the last down candle, right? We're breaking the high of the last down candle with a bullish candle. That's for the people who do not understand fractal structure, right? So this is what we're looking at. We're looking at the last down candle that is here and the last up candle that is there. But the last up candle would signify when we begin to go bearish, right? And the last down candle would signify when we begin to go bullish. So this is essentially what we're looking at, that up candle, and then we begin to trade lower, or that down candle, and then we begin to trade higher. So when you previously saw me marking out highs, and then we trade back in, and then we trade higher, and then we trade back in, and then we trade higher, and I was marking out the zones that are inside of there, the zones that are inside of there, right? Those zones that are present inside of there. That's just the market trading higher and then putting a low, trading higher, then putting in a low, trading higher, and then putting in a low, right? These are just the market building up candles on the way up, right? And this is where I'm going to stop paying attention to the chat because I'm not answering questions right now. I'm just teaching through the lecture, and then questions will be answered later on. So what we have is this down candle. The reason why the boot camp was the crash course was important for you not to speed through or ask Grok to tell you what the summary should be is because you would have learned this inside of the crash course and you wouldn't need to ask questions in regards to that. So what we see is we have this down candle that is present here. And now the market begins to make its way up. The market begins to trade higher. It all starts from a single down candle. So let's just look at something that's over here. Let's just look at a low. And what we see is we have a low that's present here. This blue candle here, right? That's a down candle. We see that, right? So we see that we end up trading up above that previous down candle that is there. So this down candle, there's nothing to the left of the down candle at all, right? We mentioned that it can't be anything down here. It has to be the lowest. So with the lowest down candle, is this candle inside of here, is that the lowest down candle? This is the 1600 candle. And then we see the 12 o'clock candle here. Is that the lowest down candle? No, that is not the lowest down candle. The lowest down candle is the candle that has the low to it, right? So if this candle here actually put in a low, then yes, this would actually be the lowest down candle. But that candle did not put in a low. So what maintains the low, the last down candle would be this 12 o'clock candle that is here, right? So we see the last down candle get put in. And then what do we end up seeing the market do? We end up seeing the market trend higher after the last down candle is there. So that last down candle, this is what I'm saying is the R box, right? That last down candle. And then to the top side, we see that we have this up candle here, right? This 8 o'clock up candle. Then we see we have this 9:45 up candle. And then we also see the 10 o'clock up candle. Which one is the highest up candle that is there? The highest up candle would be that 10 o'clock candle that's there. It is the candle that has the highest point in that entire area. It's the highest point that's there before we begin to trade lower now, right? So this ends up being what we call our R box from the high, right? So going back to the illustrations that are there, going back to the drawings, we understand that this is where the market turned up above and where it began to head down, right? This is where the market turned down below and now it began to head up, right? So we need to make sure we're paying attention to what's happening here. What's happening here is the last down candle is the most important part of price for us when we begin to turn. The last up candle is the most important part for us when we begin to turn. So this right here is what we're paying attention to. The last up candle when price began to trade lower. This is considered our R box. As I already said, stop asking me questions in the chat because I'm not answering questions right now. I'm teaching exactly what it is that you need to pay attention to. If you have not watched the videos on YouTube, if you chose to speed through the crash course videos, you're lost and that's your fault. You were prepared for this and you chose not to prepare. So you have to sit through a session to learn something the second time when you could have been already ahead in this. So what we see here is this is our down candle, and now we're producing a series of bullish candles on the way up, right? We begin to see these bullish candles that are trading higher. So this candle, we place a box around it, a rectangle, whatever it is you want to call it. We're placing a box around it, and we're calling that our R box, right? So when the market begins to trade away from this down candle, this right here is what we're anchoring our fib to. So for the people who do not understand what we mean by fib, and they likely didn't watch the videos, that's the only reason why they wouldn't understand this, is the fib, right? Whether it's the GAN box or whether it's the Fibonacci on the whether it's the Fibonacci on the tools here, right? You see fib retracement, or you see Gambox. Whichever one it is, it doesn't matter which one it is. What you're making sure you have on this fib is the 30, the 50, and the 70, right? That's the 0 and the 1 is there. If you want to put that there, I just don't have it on. But the 30, the 50, the 70, that's the only fib levels that we have. Same thing inside of here. It's the 30, the 50, and the 70, or 0.3, 0.5, 0.7, right? So when we create this R box that is here, what we need to understand is as we're moving out and we're trading higher, these candles generally have wicks to it, right? Wicks on the way down. We have a wick and then we push higher with a bullish candle, and now that ends up, putting another high. On the other end, we have a wick on the other end here. We have a wick on the other end here, right? So this is signifying that as we begin to trade higher, what we're seeing is we're seeing a high get put in. We're seeing a low on this wick. We're seeing us trade back up above. We're seeing us trade back into this low. We're seeing us trade back up above. We're seeing us trade back into the low. That all looks like market structure, right? As it's making its way higher. So with this here, this is what it's going to look like on the higher time frame. It's going to look like these candles going straight up. So when we have that market structure break that's down here, what we want to look for is our last down candle before that break. So we have the market structure break that's there, right? This high. We go up and we break that high right there. Now we're not looking at this high. We're not looking at this zone that we previously used to mark out. What we're looking at is the last down candle before that break occurred. So that last down candle that is there, that is our R box. Again, want to get this, through to you guys, that this is the most important part of the concept, the R box. It is the most important part because if you're drawing it out improperly, what tends to happen is your levels will be off and you won't get the precise taps that you're looking for within those levels, right? So here is the R box. The R box is the last down candle that is present there. So now that we have that last down candle that is there, what we need to look for is we know that the market does what? Retrace. And then we know we have a continuation trading higher, right? We see a retrace, and then we end up seeing a continuation trading higher, right? We see this as video 1, lecture 1 of the R box, right? This has nothing to do with time frames. I'm not talking about that right now. I'm just talking about the down candle. It can be a weekly down candle. It can be a daily down candle. It does not matter. It is just the down candle. We're not talking time frames right now. So what we see is the market begins to trend higher, and we put in this low and we move higher, right? We put in this low and then we end up moving higher. So when we break this high, this is the market structure break that is here, right? We end up retracing, moving up, retracing, moving up. Have you ever experienced, while you were trading with market structure zones, have you ever experienced where you were expecting price to get back into your zone that was here and it never went back into any of the levels? And then you were expecting price to get back into this zone here. And what did it do? Maybe tap the top of it right here and then actually run, right? And then we put in another zone up here and then we validate the zone up there and it just keeps going. It does not come back there, right? We left this zone unmitigated and we began to trade higher. And now up here, you're taking a zone that's present up here. And what happens? The market liquidates that zone, right? Just trades through it. And after it trades through it, you think that this is a market structure shift inside of here because we broke that low. And then what does the market do after that? Trade higher and break that high right after. right? Has this ever happened to you while you were trading market structure? Yeah, I'm 1000% sure this has been something that happened to you, because it's happened to me too. And this is the reason why we've pivoted from using structure to using a structureless system. So when we see these candles that are trading higher, we know on the higher time frame, these are bullish candles that are trading out, right? Those are not our zones. What our zones are these little down pivots that are created before we trade higher. So these are our zones. And a lot of the times we might see when the market begins to pick up some strength and continue to trend higher, we see that the market does not come back to these zones at all. It just continues to trend. And now we've gone through the whole, oh, count your swings 1, 2, 3, 4, 5, 6, 7, 8, 11. How many more swings are we going to create? Right? We see all of that. And price is not coming back into any of those zones that are created below. And it's frustrating, because we're so used to marking out our highs and lows, waiting for the retracement to trade back into the zone and then continue, right? That's what we know from the market structure standpoint. But when we have things like this, where we put in a high, we put in a low, we put in another high, and then we break that low and we think, oh, wait, that's the market structure shift that's happening now. And then we continue higher, right? We end up trading above this. We end up moving up and breaking that high. And now you want to trade with this here. So you took the loss already on this short, right? You took the loss on the long that was over here. And then you end up putting in this zone here. And what does the market end up doing? The market ends up trading through that low too. 3 losses in a row because you're using rigid market structure. It's break, tap back into the zone, trade higher. Okay, that broke, that didn't work. Okay, now we're going to go long. And then now we're going to go short, because you're just using these highs and lows to pinpoint when to go long and when to go short. And you have this little thing that's occurring inside of here. Yeah, this happens while you're trading market structure. For those who did not watch any of the videos and learn how to properly count their swings and learn how to properly follow market structure, you're probably lost right now, but you will catch up soon, right? So we see that the market begins to trade higher, right? Then it trades just a little bit lower, then it trades higher again. And you get stopped out 3 times in a row because you're anticipating, okay, down here, we were looking for the market to get back there. It didn't go there. Down here, we're looking for the market to get back there. It didn't go there. Okay, well, maybe there's some imbalance inside of here, and then the market might end up going inside of there and then actually moving higher from there to end up going up, up there, right? It ends up going lower below it. And now you believe that the market is getting ready to go lower. And then it ends up trading higher above it, right? And now you think, okay, here is the zone, because the market's going to tap back into here and go higher. And then it ends up going back below it again. And you're stuck. You're lost. It's as if, you're trying to figure out, okay, the first flip is fake. Now the second flip is there, but then the second flip failed too. What is actually happening? You're confused, right? So this is to clear all of that up. In the past, we used these zones where we were expecting the market to trade back into the zone and then give us the move higher, right? Back into the zone and then give us the move higher. Back into the zone and then give us the move higher. While there are some trends that will do that for you, it's not all trends that will do this, especially ones that are tapping into a higher time frame POI. And now we're just running. We're just straight bullish and continuing. You see the price action the past couple of weeks, right? Just going up and 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 up. Then you get a little dip and then up and up and up and up and up and up and up. It's just climbing. There's just barely anything is giving you on the way back, right? This is the price action that we've had to face over the past few weeks. And that's just one-sided price action. When people see price action like that, and we have these highs that are continuing to put in other highs, trading lower, put in highs, we feel innately, naturally, we feel as though this has been going up, and at some point there's some kind of turn that we want to expect the market to do, to come down and sweep something, right? Naturally, we're up here believing that the market up here now has to turn and go take out some low. And what happens when it doesn't actually go to take out that low? What happens when it doesn't even go near the zone that's there? Where are we when we're trying to enter a trade? We are up here trying to find a short going down, and we're getting obliterated. It just continues to trade higher, right? We have that down move, obliterated again. That down move, obliterated again, right? That down move, it fails, looks like it's getting ready to go and take that low on the downside, obliterated again. It just continues higher. This has been the price action over the past few weeks. And what happens when we don't get sweeps of these zones that are here? When we don't get price to come back and tap into those zones that are there, right? It's not coming back to take anything or to trade into the level of those zones. It's just continuing higher. How do we get involved in this? How do we get involved when price has not returned to your zone? So this goes all the way back to that down candle that's back there, right? Goes all the way back there. Goes all the way back to the R box that is here. So previously, we had marked out the down candle, the down move that's there. Previously, we had marked this out as our market structure break. So we were looking for price to come back into the range, tap into one of these levels, and then continue higher. But what we also know is that there are plenty of times that the market does not come back and tap into that range. It might come back and tap into the top and then continue higher. So what we've placed our focus on is the R box that is here, right? And we're removing the fib, and we're removing the need for a market structure break. Oh my goodness. You're trading without a break, without a comp. You're not waiting for confirmation. We're removing the need for a market structure break. You don't need that at all, right? What you need is your higher time frame POI for the market to tap into over here. Market trades into your higher time frame POI. We set that down candle that is present here. And as we begin to trade away from that down candle, what we are paying attention to now, whether this market structure break is here or not, what we're paying attention to is the retracements after the last down candle has been set. So tap into our POI, set the last down candle, we begin to move higher. And where we are anchoring our fib, we mentioned that this is the R box, right? This is the anchor. We are anchoring our fib to the high of the down candle, right? That means that the first tap of the fib is on the top of the down candle, not the body of the down candle, not, some other portion of the down candle, on the highest point of the down candle. So what does that mean? That means that if we have a wick at the top of the down candle there, right? The R box is the wick to the lowest point that's there. If we have a wick that traded below down here, then the R box ends up being the entire down candle that is there. So we are taking our fib, right? You click the fib button. You are going to tap onto the high of the down candle, the highest point that's there. And this is going to be what we call our anchor, right? So let me see if we can Well, we can't put text on this one. Let me use the fib itself, the Fibonacci here. So the high of the down candle, we're tapping that and we're going to follow it. So this is considered, let me actually just put it here. This is our anchor, our fib. So what we do is we fib the high of the last down candle, the highest point that is there. And what we are looking at, let me just move some of this out the way. What we are looking at is when we begin to retrace and trade lower, right? We are looking for, when we stop at the high up here, we are looking for that retracement to trade into these fib levels, right? This is the 30, the 50, and the 70. We are looking for this retracement. When this retracement tops out, when it starts and we begin to trade lower, we are looking for it to retrace within any of these three levels, the 30, the 50, and the 70 that is there, right? I'm going to tell you how to understand when we're going to one level over the next, but this is exactly what you're looking for. So you fib the high of the down candle that is there, the last down candle that is there. You fib the high of that. And now as the market begins to make its way higher, and then it puts in a high and we begin to retrace lower, you're expecting the market to retrace into the fib levels lower, that's down here, and then you're looking for the market to continue higher. So when it continues higher, all you're doing is dragging your anchor to the next high that is there. You are looking for the market to retrace back into the fib levels, any of those levels, and then you're looking for it to trend higher. And then when we begin to trade higher, you're dragging your fib to the high that's up there, and you're looking for the market to retrace down to one of the fib levels, and then you're looking for it to trend higher, right? And your R box that is down here, it is static. It is, you're leaving it there, right? You only move it to a higher time frame down candle when certain conditions are met, which we will go through that throughout the rest of the boot camp, right? We can't rush into everything today. You need to understand the framework of it, the beginning, the foundation. So why did we create this? Why did we move to trading this? We moved to trading this because a lot of the times when the market is trending higher, it's not coming back into our zones, or it might just tap our zones right on the top of it here and then move higher and not actually go into our levels that are down there. And we feel stuck because we don't want to short up here going back into the range, but also we don't want to long up here because we've been liquidated so many times chasing longs that we don't know when to properly engage in the long that is there, right? So we're looking at it from the lens of the last down candle when the market begins to turn and trade to the other side, right? That's the last down candle that would be inside of here. That's here. The last down candle that is there, we would take our fib, put it to the high of that down candle, and we will follow each high that's put in. And we also understand that when we trade back into these levels, here is where our entries begin to move higher. So you are no longer trading with market structure and zones. You are now trading with understanding that from the lowest point to the highest point, or each high point that's put in, the market tends to retrace by a certain percentage before it begins to move higher. So if you were to just take the price of the high of the down candle, last down candle that was there, the price of the low of the day, and look at the high that's there on that down candle from the low of the day, and begin to follow each high into the retracement lower, each high into the retracement lower, you should see that the market, let's say you took this high at 51,470, and we went up to this high here at 52 to 72. You should begin to understand that when the market begins to retrace, it's retracing by 30, 50, or 70 from the down candle's high that's there all the way to the highest point that we just put in. It's retracing by a certain percentage. And I'm going to teach you again how to anticipate or how to know which levels are going to hold. This is no longer going to be like when we take the zones that are present there to the left and we're hoping that the zone tap onto the 30. Have you ever traded a zone? Now, this is going back to market structure, right? Because these are the woes within market structure. Have you ever traded with a zone where you put the fib around the zone like this and the market went down to the 30 and tapped onto the 30 and it started to trade out and you thought that's where the market was leaving, and then it went down into the 50 and then traded up above from the 50 and then moved down to the 70, tapped onto the 70, traded lower right there? Have you ever said, hey, you know what, I'm gonna wait until we get to the 70 and I'm gonna take the entry at the 70, and it just stopped at the 30 and continue higher? I'm gonna wait until we get to the 50, and when we tap the 50, I'm going to enter it at the 50. And then it taps the top of the box and it leaves. You know what? I'm going to get it on the 30. I'm just going to take that, put my stop behind the 70. You put your stop behind the 70 and it stops you out. You know what? I'm just going to get it at the 50%, put my stop behind the low, and then you get it at the 50%. It stops you out behind the zone. This has happened to plenty of people I know. Trust me. Trust me. This is what it looks like trading market structure. All of these different variables of which level is actually going to hold. And you start thinking in your head, maybe I should put my stop 10 points behind the low. And it goes all the way for the 10 points behind the low. So yeah, the frustration with using the zones that are there, it's difficult, right? You've executed enough with the right rules, with the system that was actually taught. You executed it and you found that the execution does not line up the same way as the way that it's cleanly taught, with higher high and higher low and higher high and higher low. You realize that it's not that cookie cut, right? When people say, oh, calling price is easy, but executing it is difficult. Yeah, this is the difficulty behind it. Where you're looking to get in, the market does not stop there. It goes much lower. When you believe that now it's getting ready to go lower, it goes higher. So that is the frustrating part behind this, right? And what we want to move away from is using the order block inside of there, using the demand inside of there, using the zone inside of there, using the imbalance inside of there. We want to move away from all of that, waiting for the sweep that trades below this low. Then when we get the sweep on the draw of liquidity, now the market is going to move higher, reprice to, we don't care about that anymore. Does not matter. Keep your imbalances. I don't want to see them. I have no gap candles on my chart. I don't care about the volume imbalances that are there. Does not matter. I don't even want to look at it. It's ugly. Get that thing out of my face. Oh, here's the gap fill. I don't even see a gap. I don't see gaps. Sorry, I don't see color. I don't see gaps. It's not there. You know, that's me. I'm not paying attention to any of that stuff that is there. Yeah, there's an imbalance there. Yeah, there's a wick there. Yeah, there's all of these different competing things that are there. None of it matters at all. Not even the sweep there matters, right? What matters is that we put in our high above up there and we begin to retrace, and we retrace down into our levels that are from the high of the down candle that's there. It's anchored to the high of the down candle, and then the highest point before the retracement is very important. The highest point before the retracement. It is placed to that highest point, the wick high, right? Now, you see, I've been going through this for what, 44 minutes? Because you need to understand this detail. So this is 44 minutes that I've spent explaining everything around this R box because the R box is the most important part of this concept. You need to know where your anchor is, and you need to know how to trade when the market begins to move away from the R box. So when we put in that first high, this is the next point. When we put in that first high that is there, and we begin to turn and we trade lower, what we tend to see when we place our fib on the high of the down candle, the last down candle that's there, if there is, and I need to clarify, if there is a bullish candle at this low, right? Let's say we put in a wick below down here. If there is a bullish candle that is there, is that bullish candle the last down candle? The bullish candle there. Is that bullish candle the last down candle? Just want to get through this with everybody, make sure they understand as we're going along. Yes, the bullish candle is not the down candle, right? Because the down candle is synonymous with the bearish candle. So it's the last bearish candle that is there, right? I told you, breakout, I'm likely going to answer all of the questions on within the teaching before you even get to ask them. So that's why I save it to the end, because I clear up everything. Trust me. I've been doing this for a long time, and I know exactly what I'm doing, and I know exactly what people are going to face later on as they are learning this. So I try to teach you everything in these videos. So when you run into a problem, if you can't write to me, guess what? The answer is still there in that video, right? So the last bearish candle is the last down candle. So what we do is, if there is a wick that's here on the bullish candle, what we end up doing is dragging the box to the low of that bullish candle, right? But our fib is not put on the high of the bullish candle. Our fib is put on the high of the bearish candle, because it's the last down candle. While there was another candle that opened, created a down move, and then closed bullish going up, our R box is still the bearish candle that is there, the last down candle that is there. So we will encompass this wick, right? We will encompass that, because we have to save this for later, right? We'll go over this later, but this ends up being our R box. Now we have a larger R box that is here that encompass the bullish candle that put in the low and then traded up, but our fib is still at the high of the down candle that is there. So as we begin to trade away from this down candle, each high that is put in up here, right? Each high that's placed there, what we want to see is the wick of the high, the highest wick that is there, the highest point that is there. We drag the fib to the highest point that's up there, and then we see the market begin to turn, and the market turns back into one of these levels that are here. So this is another important part to it. I told you we're going to work this thing out. We're going to start from the very beginning, the origin, the etymology, where it all begins, and then we'll move out to the other things, the other questions that you're going to ask later on, right? Trust me, it's going to be dealt with. It's just focusing on this candle, right? So we begin to trade out, we put in the high. When we trade out and we begin to put in the high, we put in the high and then we start to retrace. The first two pullbacks, I need you guys to pay attention to this. It's not always, but the first two pullbacks, remember how we talk about the second swing in the crash course, right? We talk about the market structure break right here. And then we talk about the second swing that's put in right there, and how the market trades into the second swing, and that's the most powerful swing in the market and all. Remember that in the crash course, right? This is actually what's happening within that second swing. So we don't care about the break to the left or not. That's not our business. We no longer care about breaking a structural high. We no longer care about breaking a protected high. We no longer care about breaking a wick to the left. We don't care about any of that at all. We're just paying attention to price going into our POI to the left. And our POI to the left, it could be a zone, or it might end up being a higher time frame R box with a higher time frame R level, which we will get into in the future. So, or in the coming days. So the first two pullbacks, right? Let me move this out the way. The first two pullbacks that are here, we have this pullback here, and then we have this pullback here. The first two pullbacks often trade to the 70%, right? It's often. Now, I'm not saying always, it's often. The first two pullbacks often trade to the 70% and often trades to 70% and potentially taps into the R box itself, right? So remember how we talked about, oh, you get the down candle closure and then the market trades into the 30% or the 50% of the down candle, and then it trades out right after that close. That's essentially what that first pullback is. That first pullback is trading back into the 70% or the R box. So it can stop at that 70, it can stop at the R box. What you need to understand is that this is the aggressive entry, right? This is the aggressive entry. The first two pullbacks are aggressive entries. So we have that first pullback that goes into the 70. We have the second pullback that's up there. Now we went into the 70. We put in another high up here. So we moved our fib, we moved our anchor to the high. And now we have these new R2F levels here. This is what I forgot to mention. I realized that I didn't tell you guys this. The name of the system is R2F. It's retracement to fib levels. So our R box is our retracement box, right? And we anchor our fib to our R box, and we expect price to retrace to our fib levels. I told you, whenever it is that you say it, you know exactly what you're looking for based on what you are saying. I didn't create no delusional name for it. You need to be able to understand the model, understand what you're looking for when you hear it, right? So the name of this system is R2F, retracement to fib levels. That's it. We're keeping it strictly technical. We're not trying to coin any unique names to it, trying to give any obscurity to it. Retracement to fib levels. That's exactly what it is. So that's what you're looking for. You say it, and you should see it when you say it. So what we see here is, can you show the percent on the fib levels? I already did. I said it's the 30, the 50, and the 70 earlier in the video. 0.3, 0.5, 0.7. So I'm going to shy away from the chat and go back to what we're talking about here. So we see that we put in this high that's up above here, and we retrace back to the 70% on that second move down, right? We go back into the 70% that's here, and then we end up trading higher again on that 70. The 70 just denotes a deeper retracement, a deeper pullback, right? That's all that we're considering. So for the first two pullbacks, there's the possibility of the deeper pullback that is there, right? We're pulling back deeply into the 70%. You need to understand that with fib levels, if we are up here and we are retracing back into the fib level, if I took this box from the 30% to the high and I said we got back to here, right, at that 30%, would this be mitigated by 70%? Would this line, the first line that it pulls back into, did we mitigate it by 70%? No, that's 30% from the high to here. If it was 70%, it would be lower down here, right? So what you need to understand that the first level that you encounter is always going to be the 30%. The middle level that you encounter is always going to be the 50%. The lower level that you encounter is always going to be, or the third level that you encounter is always going to be the 70%, right? It's not rocket science. When you trade into a box, let's say that little Johnny had cookies inside of here. There's a bunch of cookies that were inside of here, right? Little Johnny ate the cookies at the top layer. Little Johnny, did he eat 70% of the cookies in the box, or did he eat 30% of the cookies in the box, right? So this is how you're going to conceptualize it. So it's when you're pulling back into it, it is 30% going back into it, right? And then it begins to trade higher. So 70% would end up being the lower portion of it. Johnny left the last cookie in the bin for you want to make sure that you paid attention to that, right? So let's get back to it. We tap into the 70% on the first pullback, and on the second pullback, we tap into that 70% too. This is most times. Are there times where the second pullback does not trade into the 70%? Yes, there are times where the second pullback begins to impulse away from that first pullback, and all we get when we move our fib to the next high that is there, all we get is the market actually tapping into the 30 and then moving higher. So what you need to understand about this is the first two pullbacks are going to be deep retracements. It can be that first pullback that's only the deep retracement, right? You don't have to force the second one into a deep retracement. What do I like to trade with? I like to wait until the first and second pullback is already established. When the first and second pullback is already established, that's just me personally. You might find a way to trade that first pullback. You might find a way to trade that second pullback, and that might be fine for you. But what ends up happening is when you're looking to trade that first pullback that is there right here, we can collapse and trade through this low. And when we trade through that low, we could end up just creating another R box down there. And now it begins to retrace higher, right? So you want to make sure that you understand the first two pullbacks are aggressive entries, and there is a possibility that the market can trade lower than the R box that is there, right? First two pullbacks are aggressive entries. Now that second pullback, if we deviate pretty far away from the first pullback that is there, right? That we're going to see likely that the market taps into that 30% and pushes out like that, right? And it taps that 30% and continues. The 70% is the deeper retracement. The 30%, when price comes back and taps into the 30% and moves off of it, that's telling you that we have a lot of momentum still in this move going up. It's letting you know that this move is still strong, right? We are still trading with whatever it is that happened at the low. There's strength coming out of this, right? So we tap into the zone. We have that first pullback, and the second pullback, we only go into the 30 and we run, right? That's telling you that this is still strong here, right? This is still strong. So when we begin to run higher, you're not trying to short anything that's up there, because this fib is telling you we have a lot of strength coming out of where we just came from due to us tapping the 30 and running. We tap the 30, run, tap the 30, run, tap the 30, run. You can see this is the second pullback, right? You can see the third pullback. You can see the fourth pullback. They all go back to that 30% because it's super bullish and very strong. The trend that's trading higher goes back to that 30%. It moves higher, goes back into that 30% again, right? It moves higher. And now you understand when we begin to push, when we begin to trade higher, now you understand the culprit behind why we never traded back into your zones, right? So he's coming together, right? Yeah. Now you understand why we tapped the top of the zone, right? Now you understand why we didn't dig into the level that you were looking, the 30%. We didn't tap into it. We didn't hit the 70 that's there. Now you understand that. Now you understand your little zone that was created up here, why that zone got liquidated, and then we traded higher from there. Now you get it. It's us expecting that retracement into that continuation, Boy, some of the people who were here in 2003, sorry, not 2003, 2023, some of the people who were here in 2024, right? And you left, and whatever reason you left for, you thought the P&L was green on the other side. I know you coming back and you're like, oh, this guy, no, oh my goodness. Yeah, trust me, we've leveled up. Trust me, we created this and you missed out on it, but now you're here, right? You're here, but this is what we're gonna focus on. You're here, right? So when we don't have price trending back into our zones that are there, it's because we're retracing back to these fib levels that are here, and we tap the beginning of those fib levels and we begin to trade out. We move higher, we tap those fib levels, and we begin to trade out. You're going to see this in any move that begins at this low, creates an R box, and begin to trade out. You're going to see this exact same thing. Whether it's the first two going back into the 70, whether it's the first going back into the 70 and the second going back into the 30 or the 50, right? We're going to get into that when we actually get to the candlestick charts. But you're going to see this. So all of those times where you were anticipating the market to trade back into a zone and it did not trade into your zone, what you were missing, what you did not see, was the fact that if you anchored your fib to the high of this R box and we began to trade out, you saw that the market tapped into the fib level, moved higher, tapped into the fib level, and moved higher. And for those people who use Fibonacci, is Roman numerals here, right? Those people who use the Fibonacci sequence, right? You have the low that's here, and then you make your way up, and then you have the high that's here, and you're using your Fibonacci. You're looking at the golden zone, right? 50%, 61.8. You want to see the market move back into that, and it doesn't get there. It actually just has a shallow retracement and moves higher. Guess what? Problem solved. You don't have to look for that golden zone anymore. There's only certain times within this trend moving up that golden zone will be hit. And the market is going to tell you when it's going to that golden zone versus when it's not going there, right? We're going to get into that in the next few days. I know it's a lot to kind of, piece together, but it should be exciting for you. You should begin to see all the struggles that you were trading with in the past and how this essentially was happening as you were struggling, waiting for those things, and you just did not see it. You just did not anticipate it, right? So this is essentially what it's telling you over here when you have that zone being tapped and we begin to impulse out and you don't get price to return back to your zone here. It doesn't return back to your zone there. It taps the top of your zone there. It doesn't return back to your zone there. It's essentially just following from this R box to each of the highs that are there. It's trading back to that 30% and moving higher, that 30% and moving higher, right? And just continuing into those highs. Now, while the 30% tells us that the market is exceptionally bullish and strong. Now, this is bearish too, right? Just know that as I'm explaining this, this is also something that accounts for the other side. So I'll invert the chart. This is where it's bearish as well, right? We end up seeing this low that's here. We pull back into the 70. We see that low that's there. We pull back into that 30. We see the low that's there. We pull back into that 30. We see the low that's there. We pull back into, right? This is still as it's bearish and going down. It would just be with bearishness, it would be the last bullish candle that is there. We already ran through that in the beginning of the video, right? The last bullish candle. You guys better make sure you understand this because you will be quizzed tomorrow on this. And if you get it wrong, you will be sent back to go and watch the beginning video and you won't be a part of that session. So I'll be calling on random people to quiz them on this. So make sure you fully understand this by tomorrow, right? So we end up seeing that we have that the high of the R box, it continues higher, it's tapping into that 30 and it's moving higher. So when does this end, right? When do we understand the change in it? When does that start to speak to us, right? This fib is not only something that you are following with the move higher. AJ, what's up? How you doing? We actually started to teach this right after you left the mentorship. I felt so bad. I even tweeted something about you. You didn't know it, but I said it pains me so much when students give up when they're right at the brink of understanding what they need to. And you were right there. But now that you're here, right? You're going to get it while you're here. So make sure you listen. So we end up seeing this market trend higher. We have a fifth high that's here. It doesn't even have to be a fifth high, right? This could end up being a fourth high. This could end up being a third high. It doesn't matter what high is actually up there. We're not being abstract. We're not essentially counting the highs, right? We did that with the swings. We're not paying attention to that. Remember, we're not trading market structure anymore. We're done with that. So what we're actually looking at is when we put in that high that's up there, and we're anticipating the market moving back down into the 30% that is there, right? What we're going to see is we're going to see the market tap into that 30% and push higher. And this is where the crash course comes in, some of the little subtle things that are in the crash course. We're going to see the market push higher off of this. But what we're going to see when we push higher off of that 30 is we're going to see a failure that occurs there. By failure, I mean we can go above that previous high and just wick it and trade lower, or we don't actually have to take the high. Crash course, you thought it wasn't important. Clearly it is, right? So we tap into this 30% and we fail to actually put in a high. What's going to happen from that 30 and the failure into the high is that's going to send us down to the 50%. This is where the 50% comes in now, right? The failure on the 30 tells us that price is looking to trade lower. Oftentimes, it's telling us that price is actually looking for the basketball there, right? Price is actually looking for the 70%. When we have the fail at the 30, it's telling us that there's a high likelihood that we're looking to go down to that 70%. Now, don't mind the 70% on the first two pullbacks, right? We already know that. But when we begin to trade higher and we have that failure up there is telling us that the trend, it's a possibility that the trend is over. Possibility, right? Listen to that. Possibility that the trend is over and it's making its way down to the lower levels that are there. What do you actually see there from the crash course that's also telling you there's the possibility of trading lower? And I know plenty of you guys see it already, right? You see that it's the equal highs, the double top that runs both lows on the inside. You see it's the rounding that's up there, right? We see all of that stuff inside of there on candlesticks, just a general overview of it, but we don't see the context of when it's happening, why it's happening, and when it's highly probable. It's highly probable under these conditions. When the market taps into that 30% and it fails to produce that high. This is why I said narrative is important inside of the crash course. Videos 4 and 5. Videos 4 and 5 dealt with that. So you would see that high that's up there, right? That double top up there that takes out the internal low and the external low. You would see the rounding that's there. What do you also see inside of there? You also see your double top or your consolidation above the zone, which lets us know that the market could potentially trade back into the 70% of the zone that's there, right? And potentially liquidate the low of the zone. So all of the stuff that was already there, And yeah, another thing, the highs that are near each other, right? The three highs that are up there. There's all of that inside of here. And we're so zoomed into this detail and trying to chase the detail without the context behind the detail. So we understand that the market begins to trade higher. We begin to have these retracements trading back into the range, moving higher. We're not having any of these levels, any of these zones being tapped into. We don't care about that. We're fine, right? We understand that we retrace back to a certain level, continue higher, retrace back to a certain level, continue higher. And when we get back to a certain level and there's a certain characteristic that appears around that level, now that is telling us, it's tipping its hand to us and letting us know, hey, while you're up here trying to take your long, right? While you're up inside of here trying to take your long off of the SNDR, off of, right? We could have broke a high over here. And you said, oh, that's the SNDR to now trade higher there, and it just runs through there, right? It breaks that low. We could have put in a small swing inside of here, and then we broke the low of the small swing, and then we traded down in here and moved back up into that range, right? It doesn't matter what it is. We need to know where we are. Context, awareness, right? We need to know where we are. There can be nothing there. There can just be an imbalance that's here. And we're not paying attention to the imbalance or the gap that's there. What we're looking at is the retracement to the level and the possible continuation off of that level. So when we tap into the 30, a lot of the times what we are looking for is we're aiming for the high, right? We're aiming for the high on that 30 that's there. But we are not looking to take profit at the high. You can allow a runner to go there, whatever it is you want. We know that at some point the 30 can fail. The 30 can even fail on the second swing down here. We could have that tap onto the 30. It fails to put in a high. We go down into the 50 and then actually move higher off of the 50 from the second swing. The Fib is just telling you what to anticipate, what to expect, right? So we end up seeing this high get put in, and then we see us tap into this 30 and we move higher. But a lot of the times, this is where you're looking for the market to go higher because there's some high that's over here. That's buy side liquidity. Buy side smooth edges. It's going to go up there. You know, that's what you're thinking in your head. And we don't even go there. We just fail and trade back below, stop you out, come back and take your stop loss, right? Or come back and take you out of break even. You're paying attention to that and not knowing the context of if this is to fail over here, then what's likely to occur is it trades to the downside back into that 70%. But on the way to that 70, this is very important, right? It is all important. On the way to that 70 that's there, let me move this over right here. On the way to that 70 as it's headed down, what we're going to see is we're going to see the market tap the 50 and likely push back up to the 30. The market taps the 50, pushes back up to the 30. If it gets trapped here at this 30, or if it moves higher above the 30 and fails to take the high, when it begins to make its way back down, it is going for that 70 that's there, right? It's going to look and tap into that 70. What does this look like now to you guys? A broader rounding that's occurring. What does it look like now to you guys? The market structure break that actually holds and sends us lower, right? It's within the context of those little things that are happening that allows you to know when it's high probability or not. What does this look like? The SNDR that's right there on the break of the origin, right? You have all of these things that are present there that you're looking for standalone, but you're not looking for it in context. So while we've learned market structure, while we've understood different subtleties around the highs that, you have the first high here, the second high here, the third high here. That third high comes down and take the internal low that's there. It moves back up and then it ends up taking the other low that's there. You're paying attention to all of that that's happening inside of there as just little details, but not within the context of where that detail is occurring. So now we understand that it's around something that's been hidden to us, and we really didn't see it like this until now we're getting into the meat of it, getting into how price looks with it. So the failure, we have the failure that's here, right? That's the first sign of the trend becoming exhausted, that we actually fail after tapping the 30. There's some times when we go below the 30, we move back up, we don't really go to the high, and then we trade lower, right? But a lot of the times you're going to see us tap the 30 exactly and trade near the high and then move down, right? So when we get to that 50%, mind you guys don't hear me saying anything about, oh, when we sweep the low and then tap into when the imbalance is here lined up with you don't hear me saying anything like that, right? Because we don't care about those things. That doesn't matter to us whose stop is behind what. We don't care. What we care about is our fib being our guide for us, telling us exactly what it is that's occurring within the narrative of the market. So we get back down to that 50 moves back up to the 30. And sometimes it can trade through the low of the 50 and just continue. We're going to go over confirmation entries that are at each level that you will be able to trade from. That's day 3. Day 3, we will go over the only confirmations you will take at these levels. It's not an inside bar. It's not a buy stop. It's not a candlestick structure closure. It's not a SCE candle. It's none of that stuff that's been taught in the past. It's going to be a specific thing that you see, and it's going to give you 2 opportunities to get in, right? One of them you could be stopped out on, and the next one, you know exactly when to get in. So there's no revenge trading. It gives you your exact opportunity to get your money back from the market and then some, right? I know. I spent a lot of time doing this, and I found a lot of confidence in trading this, and I made a ton of money with this, and I've created a ton of profitable traders with this, and I've restored people's confidence who were fearful and had anxiety because of blowups in the past. Now they're trading as if they have no fear in the market. They're trading like 20-year institutional traders just off the confidence of this system alone. The system accounts for everything. It accounts for your tilt. It accounts for your mismanagement. It accounts for you being early. It accounts for all of that. But you have to follow it the way that it is taught. You have to follow it the way that it is taught. Because that's going to keep you in line with being able to benefit from exactly the way the system works. Right? So for the guy in the Discord, Roman numerals, right? When we talked about the fact that we trade down and you said the 66.69420, whatever levels you were using, you said it taps into there and then it often hits there, right? You need to understand that sometimes we trade near that 70% and then we move away. And then we go down to the 70 and then we actually hit the 70 and move off of it, right? That's the thing that's going to get you cooked. That's why you don't deviate from any of the things that are being taught here, because that little small thing is going to be the reason why you take more stop outs than the system will actually give you. So it's important that you stick to this, right? So when we're trading down into that 70%, how many of you have used a Fibonacci where you end up looking at this high that's above up here? You're looking at this high that's up here. Let me just change the color. And you're looking for it to go down into the 61.8. And it goes down to somewhere in between the 50 and 61.8. and then it moves higher and trades up like that, right? And you're wondering why it didn't hit the 61.8. You didn't want to get in at the 50. You thought it would go to the 61.8, and it actually didn't hit the 61.8, tapped the 50 and traded higher. Well, that's because you had your fib from the low to the high that's there, and the market traded back into the 50% and moved up. But if you had your fib anchored to the high of the down candle, the market would have traded to the 70%. And whether we hit the 61.8 or not, the 70% got hit. Right? So we see that we tap into that 30, we fail to put in a high after tapping into that 30, and then we begin to trade down. We move into the 50. That 50, we tap on the 50, move back up to the 30. We get stuck there, or we don't have to move back to the 30, right? We could end up just trading through the 50 and go to the 70. Here is where you're essentially looking at another opportunity to trade off of that 70 that is there, right? Each level is going to provide an entry for you, whether it is failing and continuing to the downside, right? Or whether it is holding and continuing to the upside. They still give you an entry coming off of it, even though that entry fails. Even though that entry fails, it still gives you something trading off of it. So for all those people who counter trend trade and they get stopped out and then it actually goes their way and then it continues in the direction while they were counter trend trading, you know exactly where to counter trend. This is telling you, don't counter trend above this, don't counter trend in between these levels, counter trend at the level that is there. But you shouldn't counter trend at all. You shouldn't have to, because this is essentially something that's going to keep you on the right side of the market. So what we're looking at here is, what we've gone through today is, we've gone through the fact that as we are moving higher from the down candle into the highs, we see the retracements going back in. The first two retracements trades into the 70, right? First two retracements, they trade into the 70. And then what we end up seeing is it moves higher. We end up seeing the 30 retracement. We end up seeing a 30 retracement. We can get a 30 retracement. It fails, and then a 50 retracement, and the 50 sends us back up, right? The 50 doesn't have to stop at that 30. This is why I said don't pay attention to counting swings that are there. The 50 can go, we can tap into the 50, and the 50 can end up putting in a new high that's up there. And now we just continue. We take the fib, bring it up there, and now it trades back into the 30. And then if it fails off that 30, then it does the same thing off of the failure of that 30. And what do we know that as? We see the rounding, we sweep the internal wicks that are there, the prominent wicks, and then you see us trade higher, and then you see us come back and tap into the zone that's up here, and we tap into the zone that's up here, and then we end up moving off of the zone and trading high. You see all of that just based on the zones, the market structure, all of that other stuff that we've been using in the past, but it can be simplified to just pulling your fib from the R box and then following the fib and looking at the data that it's giving you at these levels to continue making its way higher or lower. Good question. You asked, do we pull the fib from the other end? So no, you do not. The only time you would pull the fib from the other end is if we tapped into a higher time frame level over here, right? And now we got into that higher time frame level and we begin to trade lower. Now that's where your fib pull is. You get the retracement going back into the 70. You get the retracement going back into the 70. There's those two swings that are there, right? And then we go into the 30, we trade lower, we go into the 30, we trade lower, right? The only time you would pull that fib is when we get to a higher time frame level, higher time frame area that you are looking for the market to reverse from. Because what you end up doing is running the risk of what's stopping you from pulling the fib in this high. What's stopping you from pulling the fib in this high? What's stopping you from pulling the fib in this high? each high that is there that we begin to retrace back, this can be the weekly time frames, it can be the daily time frames, it can be a 4-hour time frame, 1 hour, whatever it is. Each high that we begin to retrace and trade back, you're looking now for that fib from the other side to respond, and you're getting stopped out on it because it's just moving higher with what the actual trend is doing. So the context is when we get back to those higher time frame levels. What happens is when we trade, let's say this is a 15-minute time frame right here, 15-minute down candle, and we trade back into the 70. When we trade back into the 70 right here, you're going to learn what to do on the lower time frames to be able to trade higher. We're going to go over higher time frame to lower time frame context, but what we need to first understand is how to use the fib levels first, right? You don't need to pay attention to the higher time frame as of yet because you're not there yet. You need to know how to interpret what the market is doing on the fib levels, and then you will take this same interpretation from the framework into all time frames that are there, right? Into all time frames that are there. So when we move this into all time frames, you're going to see the same thing cyclically happening across several time frames. That's the fractal nature of price, right? So if you go to the most parabolic assets that you've seen in the market, start with that last down candle that's there and look and see if we actually retraced back to those levels, right? Go to Bitcoin, take the low from, what was the low back in, what year was that? 2022 maybe? Or 23 might have been. Take the low that's there from 23. Look for the retracement. Go to NVIDIA right before it went parabolic. Take the low that's there. Look for the retracement. You're going to see some of these same things. That we move back into some of these ranges and we continue to push higher. Move back into some of these ranges, continue to push higher. What we are looking at is we're looking at a solution or a fix for when price doesn't return back into our previous ranges that are here. But what we're also looking at is how to take part in parabolic continuations when the market is not giving us a retracement back into our levels. Now we just need a retracement, not into the zone that's there, not into the imbalance, not into the down candle, not into the wick, not into the IFVG, not into the obstetrician box, not into whatever it is. We're not looking for any of that. We are looking for it to return back to our fib levels and then give us that response off of the fib level. I have not taught you guys how to enter on the fib level as of yet, right? Which we're going over that day 3. We need to take this framework, take it to the higher time frame, and when we move this to the higher time frame, what we're going to look at is the higher time frame to lower time frame context, and then we're going to learn the model that's inside of there. Each time we tap onto the fib, each level that we tap into, there is a model that shows up at those levels. You're not just blindly trading these levels. You're not just saying, oh, we get the tap and then buy stop, right? We get the tap, put my stop behind the other level behind. You're not trading that. There's a specific model that will show up for those who are conservative, and those who are aggressive. There's a model for you too. That's it. You're just looking to pay attention to 2 things, right? 2 different kinds of entries, and that's it. Nothing else. You will never enter on anything else again other than whether that conservative model fits your personality or whether that aggressive model fits your personality. And both of them have a defined stop loss each and every time, right? It might look slightly different, but it's still the same exact thing you're paying attention to. And the target, that's up to you. The whatever it is you're targeting, it's all based on the context of what the market is actually doing. So we're going to go over the higher time frame context of all of this. What happens next after this? What happens when we invalidate the R box, right? What happens when we were expecting price to go back into the 30 or the 50 or the 70, and then it actually takes the low of the R box? How do we use the other side to know when price is tapping into the other side and then rejecting back down to put in a low? We're going to go through all of that, right? Every bit of it. But this is something that you need to digest now. Again, you need to pay attention to that down candle, and we begin to move out, and then the retracements. Two of the retracements can go into the 70, but if the first one goes into the 70 and the second one begins to run away, we are only looking for that 30 or that 50. We're not looking for the 70. Unless the first one is this is context. We have our RB that's down here. RB is our box. We have our RB that's down here, and we have that first pullback. It's a very large pullback like that. We have that first pullback and we begin to run. That's when we're looking for the very large pullback into that 72, right? It's when we have a significant run away from that R box that's there. We have our little down candle inside of here, and then we see a significant run from that down candle. We have a large pullback here, and then we have a large pullback here as well, right? All that ends up being is, remember, over here, we had our structure break, which we don't really care about that these days, but we had our structure break that was there. And there's the first swing, there's the second swing. This is just price tapping back into the second swing and continuing higher. So this is essentially what we're paying attention to. And you can still use the structural zones if you want, but it's better to use the levels. I particularly wait for when we begin to move out and move back into the 30 here and trade higher, because this is higher in probability for me. This right here, this is higher in probability, meaning that if we get up there and we begin to move down, we should see a sharp move coming off of that versus having to sit in any consolidation around where we initially broke. So I'm just looking to get in on the ride the rest of the way versus trying to struggle with any of those lows. You can think that this is actually going to hold here, right? You can think that this is the first pullback right here is going to hold and trade higher, and you're trying to trade something inside of here. What happens when it goes low like that? Now you got stopped out right here. You stopped out at that level because you try to trade the first pullback. Or what happens when the first break is the fake break, and then it goes lower and actually takes out both of the lows that are there? So you need to understand what's higher in probability and what's lower, not lower in probability. I don't want to say that, but what's aggressive. The aggressive is when we first start. The conservative is when you see the momentum picking up and we're going, right? You're not paying attention to the structure breaks that are there. You're not looking at anything else other than how we've moved into these levels. First two taps into the 70, or the first tap into the 70 and the second tap goes into the 30 or the 50. The second tap could fail at the 30, trade lower into the 70, and then move back up. Doesn't matter what it is. It's just your anchor on your R box, and then the market trading higher, and then you following it every step of the way. Now, you're going to have questions in regards to what happens when we put in the R box that's down here and we actually begin to run out and we are not retracing back to any of those levels that come from that R box. That will be dealt with at a later time. Like I said, everything cannot be taught today in this video because, some people's attention span, they wouldn't even watch the 40-minute video or the 20-minute video in the crash course. What makes me think they're going to sit here and be able to absorb all of this? So you have to give people time to be able to learn this first part and then move it into what will encompass the next few parts. So this is the framework. This is what we are looking at based on the R box and then based on how we begin to run out. And again, the same thing applies to the bearish side, right? Let's say this is the RB on the bearish side. It's the last up candle on the bearish side. On the bullish side, it's the last down candle that is there that we begin to drag our fib from. And then this is the same context that we're paying attention to. So we talked about the failure that's there, but there are other things that you are going to learn that will let you know when the market is getting ready to retrace before the failure even happens. There's a ton of detail in this, but it's simple and it's all cohesive and it all attaches itself to the previous thing that has been learned, right? So this is the foundation of the framework, the R box, the last down candle that's at that low, and then we begin to trade out. And then we'll follow it across several time frames when we go over this tomorrow for day 2 to be able to use higher time frame to lower time frame to understand the narratives that are around this. And then we'll get into the model and the confirmation entries. But you have to make sure that you are keeping up just with this basic information that's here. I don't want to make this video too long so people lose their attention span, people speed through it, people give grok it to summarize it. We don't need any of that foolishness. We just want to make sure that people are applying themselves and the context is clear in what it is that they're learning. And then, we'll move from there. I'll try to dub some of these videos in different languages if I can. That's going to take me a few more days than just the next day, right? I'll try to dub some of them in the language that, you speak in. I'll open up a channel to request what language you speak in and then put it in the Discord. So this video has to render and then it will be available the next day, or if it renders tonight, then it'll be available in the Discord and you can download it. It won't be a link for YouTube. It will just be something you download to your device.